Welcome to Iraqi Dinar News, where you receive real and authentic updates about the Iraqi dinar. If you want to stay informed with moment-by-moment developments, make sure to subscribe to the channel and like the video. Today, we are diving deep into one of the most widely debated topics within the Iraqi dinar community and broader discussions on Iraq's economic future. The difference, relationship, and potential overlap between currency redenomination and currency revaluation. In recent discussions across financial forums, news commentary, and social media, a specific perspective has gained significant traction. This viewpoint suggests that the ongoing talk regarding removing zeros from the Iraqi currency is not merely a technical accounting shift, but rather a dual process where a structural redenomination occurs alongside an upward revaluation of the currency's intrinsic purchasing power. According to this narrative, domestic citizens inside Iraq would experience an increase in real purchasing power accompanied by newly minted banknotes, while international observers and foreign currency holders outside Iraq would potentially see a return on their financial holdings. Because this subject sits right at the intersection of monetary policy, central bank strategy, and retail market speculation, it requires a comprehensive, step-by-step financial analysis rooted in standard economic theory, central banking mechanics, and the documented policies of the Central Bank of Iraq. To evaluate these claims objectively, we must first break down what monetary authorities actually mean when they talk about removing zeros, or redenominating a national currency. In classical monetary economics, currency redenomination is defined as a purely administrative and technical modification to the nominal unit of account. When a nation experiences prolonged periods of high inflation or severe currency depreciation over historical decades, the face values of its physical banknotes can swell into the tens of thousands or millions. Carrying out daily commerce in such an environment requires immense quantities of paper cash, complicates corporate accounting ledgers, strains commercial banking software, and introduces administrative inefficiencies across retail points of sale. To resolve these logistical burdens, a central bank may pass legislation to systematically remove a set number of zeros, such as 3 zeros, from the currency. Under a standard redenomination model, if 3 zeros are deleted, a note with a nominal face value of 25,000 dinars is replaced by a new note with a face value of 25 dinars. Simultaneously, the prices of goods, services, wages, bank account balances, and government debts are scaled down by the exact same mathematical ratio of 1,000 to 1. Consequently, a loaf of bread that previously cost 1,000 old dinars would cost exactly 1 new dinar. Because both prices and monetary supply are adjusted symmetrically, the actual real purchasing power of the individual remains completely unchanged. Economists classify this standalone event as a net neutral monetary restructuring because it alters the nominal expression of value without altering the underlying economic value itself. On the other hand, currency revaluation represents an entirely different economic phenomenon. Revaluation refers to an official decision by a monetary authority operating under a fixed or pegged exchange rate regime to increase the official exchange value of its domestic currency relative to foreign baseline currencies, such as the United States dollar, the euro, or a basket of international reserve assets. Unlike redenomination, an upward revaluation directly shifts the relative price of domestic currency against international foreign exchange. When a currency is revalued, holding a unit of that currency allows the owner to purchase a greater quantity of foreign currency or foreign-denominated goods and services. In practice, sustainable revaluations are driven by strong economic fundamentals, including expanding foreign exchange reserves, sustained current account surpluses, rising national productivity, robust fiscal health, and reduced economic vulnerability to external shocks. Therefore, while redenomination is an internal administrative redesign of a nation's physical cash and ledger units, revaluation is a fundamental adjustment to the international purchasing power and pricing structure of that currency relative to the rest of the world. The core proposition put forward by proponents of the dual action theory is that the Central Bank of Iraq will not execute a standalone redenomination, but will instead pair the removal of zeros with a concurrent upward revaluation of the dinar's baseline exchange rate. To analyze whether such a dual event is economically plausible, we must examine how monetary mechanics operate when both measures are considered at the same time. Theoretically, a central bank possesses the sovereign authority to alter both the nominal scale of its currency and its official pegged exchange rate within the same policy framework. For instance, if a central bank decides to delete 3 zeros from its currency, while simultaneously adjusting its exchange policy to strengthen the real purchasing power of the currency, the resulting transition would involve two distinct mathematical calculations. The first calculation scales down the cash supply and domestic price levels, while the second calculation re-anchors the currency's value higher against foreign currencies. However, central bankers and sovereign finance experts approach such combined policies with extreme caution, because mixing a technical currency transition with a real purchasing power shift creates complex economic ripple effects that directly impact inflation, trade balances, government expenditure, and foreign exchange reserves. When we examine the domestic impact on Iraqi citizens under these scenarios, it is vital to distinguish between nominal changes and real economic gains. If Iraq were to undergo a standalone redenomination, the immediate experience for local citizens would be a simplified cash landscape. Instead of carrying heavy stacks of high-denomination bills for basic grocery purchases or real estate transactions, citizens would handle smaller modernized banknotes. Their monthly salaries would look smaller in absolute numbers, but because rent, food, fuel, and utility bills would be scaled down by the exact same proportion, their standard of living and actual purchasing power would remain identical. Conversely, if the Central Bank of Iraq were to successfully strengthen the real purchasing power of the dinar, whether independently or alongside monetary reform, the primary benefit for domestic citizens would be a reduction in the cost of imported goods. Because Iraq is a heavily import-dependent economy that relies on foreign trade for a vast portion of its consumer goods, electronics, processed foods, and building materials, a stronger domestic currency reduces the local dinar cost required to buy imported merchandise. This can lower domestic inflation, preserve consumer savings, and increase the real living standards of everyday workers whose earnings are denominated in dinars. However, achieving a sustainable increase in domestic purchasing power is not simply a matter of decreeing a new exchange rate on paper. In the real world of global macroeconomics, a nation's currency value is ultimately backed by its underlying economic output, balance of payments, and monetary reserve coverage. For Iraq, the financial architecture is uniquely tied to crude oil exports, which generate the vast majority of government budget revenue and virtually all of its foreign currency inflows. When the Central Bank of Iraq manages the exchange rate of the dinar against the US dollar, it relies heavily on its foreign exchange reserves, which are funded by oil sales deposited through official international accounts. If the central bank attempts to artificially set the dinar's exchange rate significantly higher than what its macroeconomic fundamentals and reserve ratios can support, it faces the immediate risk of draining its foreign exchange reserves to maintain that rate. Therefore, any structural effort by Iraqi authorities to enhance the dinar's value over the medium to long term requires non-oil economic growth, expanded taxation and tariff collection, enhanced banking sector integration, effective control over parallel market exchange rates, and strict adherence to international financial standards. Now let us turn to the position of foreign currency holders and international observers who hold physical Iraqi dinar banknotes outside the country in anticipation of a financial return. This is precisely where many retail market participants express the most intense interest, but also where significant misunderstandings regarding international banking rules and currency convertibility frequently arise. It is critical to understand that the global financial system operates under strict regulatory frameworks governing physical banknote exchanges, cross-border capital transfers, and anti-money laundering protocol. Holding physical foreign currency paper notes in a private vault or home safe outside the issuing country presents distinct operational dynamics compared to holding institutional electronic deposits within a regulated domestic banking system. If a sovereign central bank conducts a currency redenomination, it establishes a formal transition timeline during which old banknotes can be exchanged for new banknotes at designated commercial banking windows inside the country. For international holders, exchanging physical notes requires access to authorized financial institutions, international currency exchanges, or correspondent banking networks willing to accept the old physical series and supply new notes or local fiat currency. In a scenario where a central bank executes a pure redenomination, an international holder of 25 million old dinars would see that holding converted into 25,000 new dinars. Because the exchange rate against foreign currencies would also adjust by the same 1,000 to 1 ratio, the total foreign currency value of the holding before and after the transition would remain virtually identical, minus any transaction fees, conversion spreads, or shipping and handling costs imposed by financial intermediaries. On the other hand, if a scenario were to occur where an upward revaluation took place, the total underlying value of those holdings would theoretically increase in foreign currency terms. However, retail market participants must account for practical market realities. International currency exchanges and major commercial banks operate on supply-demand, regulatory compliance, and profit margins. They charge buy-sell spreads, processing fees, and compliance verification costs that can eat into nominal gains. Furthermore, sovereign central banks routinely impose strict capital controls, daily redemption caps, and verification of origin requirements during major monetary transitions to prevent capital flight, illicit financial flows, and speculative shocks to their domestic economy. Assuming that physical notes can be instantly liquidated at full theoretical value without friction, overlooks the standard compliance and institutional hurdles inherent to global currency markets. To gain a complete view of how currency reform impacts Iraq's financial landscape, we must examine both the short-term and long-term economic implications for the domestic economy, the commercial banking sector, and international trade partners. In the short term, any major monetary reform, whether a technical redenomination, an exchange rate adjustment, or a combined transition, introduces operational challenges and logistical friction. When new banknotes are introduced into circulation, the Central Bank of Iraq must oversee a multi-phase implementation campaign. Commercial banks, automated teller machines, accounting software, tax systems, and point-of-sale terminals across all 18 governorates must be recalibrated to process the new currency units, simultaneously alongside the old units during a dual circulation period. During this dual circulation phase, businesses are required to display prices in both old and new dinars to prevent consumer confusion, price gouging, or artificial inflation stemming from rounding errors. Short-term public psychology also plays a massive role during currency transitions. If the general public does not fully comprehend the technical nature of a redenomination, panic buying, merchant confusion, or temporary flight into stable foreign assets like the US dollar or gold can occur. This is why central banks around the world invest heavily in public education campaigns months before distributing new physical notes. In Iraq's specific context, bridging the gap between the official exchange rate set by the central bank and the parallel market exchange rate found in local exchange houses remains a top short-term priority. As long as a noticeable gap exists between the official rate and the informal market rate, structural distortions persist in retail pricing and trade settlement. Therefore, in the short run, monetary authorities focus on stabilizing domestic prices, ensuring adequate physical cash liquidity, managing parallel market volatility, and ensuring seamless interbank settlement across the financial system. Looking at the long-term economic implications, the outlook depends on Iraq's broader structural reforms, fiscal discipline, and institutional modernization efforts. A successful currency redenomination, if executed under stable macroeconomic conditions, delivers significant structural advantages to Iraq's domestic economy. By removing excess zeros, financial statements become cleaner, national statistical databases become easier to manage, and everyday cash transactions become far more efficient. This administrative streamlining reduces the physical costs associated with printing, transporting, sorting, and destroying large volumes of paper banknotes, saving the state substantial financial resources over time. Moreover, a modernized currency structure enhances accounting clarity for foreign corporations, international investors, and multilateral institutions, considering direct investments in Iraq's infrastructure, energy, agricultural, and manufacturing sectors. From a broader macroeconomic perspective, long-term stability and sustainable purchasing power cannot be achieved through monetary policy alone. Currency strength is a reflection of economic productivity, governance, and institutional health. For Iraq to build a truly resilient dinar over the coming decade, several key structural pillars must align. First, the Iraqi government must continue expanding non-oil revenue sources to to reduce state budget dependency on volatile global crude oil markets. Second, the country must accelerate digital banking transformation and financial inclusion. Currently, a significant portion of domestic transactions in Iraq still take place in cash outside the formal commercial banking system. Transitioning consumers and businesses toward electronic payments, point-of-sale card transactions, and digital accounts increases bank liquidity, improves tax compliance, and grants the central bank far more precise control over national money supply and inflation. Third, ongoing compliance with global anti-money laundering and know your customer regulations strengthens Iraq's correspondent banking relationships with major international financial hubs, enabling smoother trade settlement and boosting foreign investor confidence. When evaluating commentary regarding potential quick wealth or guaranteed returns from currency speculation, it is essential to maintain rigorous analytical standards and realistic expectations. Financial markets operate on risk, liquidity, supply and demand, and no sovereign nation restructures its monetary system for the purpose of enriching non-resident speculative currency holders. Central banks design monetary policy strictly to serve domestic economic interests, maintaining price stability, controlling inflation, fostering sustainable employment, protecting national foreign reserves, and facilitating domestic and international trade. While speculative narratives often promise overnight revaluations, historical precedent across emerging markets shows that currency reforms are slow, highly controlled, legislative and institutional processes that unfolded over years of planning and careful execution. Investors and observers who choose to follow the Iraqi dinar should do so with a clear understanding of the financial risks involved. Holding unbacked physical paper currency from an emerging market exposes holders to holding costs, inflation erosion, exchange rate fluctuations, geopolitical risks, liquidity limitations, and potential regulatory changes regarding note exchange windows. Rather than relying on unverified claims or speculative hype, responsible market participants monitor official announcements directly from primary institutional sources, including the Central Bank of Iraq, the Iraqi Ministry of Finance, the International Monetary Fund, and the World Bank. These institutions publish detailed economic bulletins, balance sheet data, reserve figures, and policy roadmaps that reveal the true direction of Iraq's monetary trajectory. In summary, while the concept of combining a currency redenomination with an upward revaluation remains a frequent topic of debate, understanding the clear economic distinctions between these two mechanisms is vital for anyone tracking Iraq's economy. Redenomination reorganizes the nominal cash structure to improve accounting efficiency and daily commerce, while revaluation alters the real international purchasing power based on macroeconomic strength, reserve backing, and institutional reform. As Iraq continues to modernize its banking sector, stabilize inflation, and pursue economic diversification, monitoring these developments through an objective, evidence-based lens ensures that you remain accurately informed without falling prey to unrealistic expectations. Thank you for tuning in to this detailed economic analysis. If you appreciate balanced, factual, and research-driven updates on the Iraqi dinar and Iraq's financial ecosystem, please consider liking this video and subscribing to the channel for responsible and authentic coverage. Please remember that all content provided in this broadcast is strictly for educational and informational purposes only, and should never be construed as personal financial, legal, or investment advice. Always conduct your own thorough research and consult with a licensed professional financial advisor before making any financial or investment decisions.